You think you know banks, but do you really? We trust banks to keep our money safe, right? But what if they're actually working against us? Once a billionaire HeneryFord claimed, "It's a good thing a lot of people don't even know how the banking system works, because that would be a revolution before tomorrow morning." The truth about banks is more sinister than you can imagine. So, get ready to uncover the dark secrets of the banking industry.
Hello. My name is Montague William III. And what I will tell you may well sound absurd, but the less who believe it, the better for me. For you see, I'm in banking and a big industry. For many a year we have controlled your lives, while you older struggle and suffer in strife. We created the things that you don't really need, your sports cars and fashions and plasma TVs.
My name is Wolf, and I'm here today to reveal the darkest side of banks that banks don't want you to know. So stick with me to the very end of the video to find the truth about bank and their banking system. Let's start by understanding the history of banks. The concept of banking has been around for thousands of years. In fact, some historians believe that the first banks emerged in ancient Mesopotamia over 4,000 years ago. Back then, people would exchange goods and services directly with one another. But as trade became more complex, people started using various forms of money to facilitate transactions. One of the earliest forms of money was coins. The ancient Greeks and Romans minted coins that were made of precious metals, such as gold and silver. These coins were a convenient way to exchange goods and services, but they were also heavy and cumbersome to carry around. As trade continued to grow, people started using banks to store their money and conduct transactions. In medieval Europe, merchants would deposit their money with money changers, who would keep track of their accounts and exchange their currency for other forms of money. This allowed merchants to conduct business more easily and safely than carrying around large amounts of coins. Banks as we know them today started to emerge during the Renaissance era in Italy. Wealthy merchants would deposit their money with banks and receive notes or bills in exchange, which they could then use to make purchases or pay debts. These notes were the precursor to modern banknotes, which are still used today. Over time, banks evolved to offer a wide range of financial services, such as loans, mortgages, and savings accounts. Banks also became important players in the global economy, financing major projects and investing in various industries. However, banks have also been associated with numerous controversies and scandals throughout history, such as the subprime mortgage crisis of 2008 and the Enron scandal of the early 2000s. Despite these challenges, banks continue to play a crucial role in our modern economy, providing financial services to individuals and businesses around the world. Have you ever wondered how banks actually work? Where does your money go when you deposit it? And why don't banks store physical money like they used to? To understand how banks work, we first need to understand the concept of fractional reserve banking. When you deposit money into a bank, the bank doesn't just hold on to that money. Instead, it uses that money to make loans to other customers. Banks make money by charging interest on those loans. This means that they are incentivized to make as many loans as possible while still maintaining enough reserves to meet the demands of their customers. But where does the money for those loans come from? That's where the concept of fractional reserve banking comes in. Banks only need to keep a fraction of the money they receive in deposits on hand as reserves. The rest of the money is available for lending. This system works because not everyone withdraws their money from the bank at the same time. Banks use statistical analysis to estimate how much money they need to keep in reserves to meet the demands of their customers. So, why don't banks store physical money like they used to? The answer is simple: it's just not practical. Banks deal with millions, if not billions, of dollars in transactions every day. Storing physical cash is expensive, and it also makes banks vulnerable to theft and fraud. Instead, banks use electronic systems to track and manage their accounts. When you withdraw money from an ATM or make a purchase with your debit card, the bank simply subtracts that amount from your account balance. Bank's business model. Banks are an integral part of the modern economy, and for many people, they are the go-to place for financial transactions and services. But have you ever wondered how banks themselves operate as a business? At its core, a bank is a financial intermediary that accepts deposits from customers and uses that money to make loans and investments. This is how they earn revenue and generate profits. Banks make money in several ways. One is through the interest they charge on loans. When a customer takes out a loan, they pay interest on the amount borrowed, which is how the bank earns a return on its investment. Another way banks make money is through fees. Banks charge customers for various services, such as ATM withdrawals, wire transfers, and overdrafts. In addition to these revenue streams, banks also invest their deposits in various financial instruments, such as stocks, bonds, and mutual funds, in order to generate additional returns. But as with any business, banks also face risks. One of the biggest risks is the possibility of loan defaults, which can result in losses for the bank. To manage these risks, banks use a variety of tools and strategies, such as diversifying their loan portfolios, setting aside reserves for bad debts, and conducting regular credit assessments. Now let's cover some main dark sides of banks. Banks are institutions that are meant to safeguard our money and provide financial services to the public. However, behind closed doors, many banks have a dark side that is hidden from the public eye. One of the darkest secrets of banks is their involvement in money laundering. Criminals use banks to launder money obtained through illegal activities, such as drug trafficking, arms dealing, and human trafficking. Banks can be complicit in this activity by knowingly turning a blind eye to suspicious transactions or failing to report them to authorities. Another dark secret of banks is their involvement in predatory lending practices. Banks have been known to target vulnerable communities with high-interest loans and hidden fees, leading to cycles of debt and financial ruin for many families. Banks have also been involved in fraud and other unethical practices. For example, some banks have been caught manipulating interest rates for their own profit, leading to billions of dollars in losses for investors. Others have engaged in fraudulent practices, such as selling toxic assets and misleading investors about their true value. Finally, banks have been known to prioritize profits over the well-being of their customers. This can lead to banks charging high fees and denying loans to those who need them most, while rewarding wealthy clients with special treatment and incentives. Another fact about banking system is that bank will not going to give you a loan if you aren't rich. First, they will examine you by your bank account transactions. And if you don't have account, then the bank employee will look at your looks. And they are well trained, and also they get a commission on lending loans. And if they figured it out that you aren't rich, they will not going to give you any money. Actually, they try to find rich peoples and business corporations to give them money, even if they can't able to return the loan. Bank will try to sell the part of their business to take their money back. In conclusion, bank don't take risk that leads them to losses. So they always look for to find win-win position. The reality is, banks make money by your money. The biggest customers of banks are the banks itself, serving other customers as a secondary. When you deposit money in the bank, it became asset for banks. And money borrowed from banks also remains its asset. The bank is in an almost win-win situation. Therefore, it always acts in its own interest. Banks will never fight for the person who keeps the money in them. They fight for more interest and control. The fact is that, once you deposit your money in a bank, then your money is no longer just your money. It also becomes an asset of the bank. A bank's credit limit always depends on how many deposits it holds, and the ratio is always unfair. So, that's it for the today video. Hopefully you learned something new, and please make sure to subscribe our channel. and stay tuned for our new upcoming videos. Thanks for watching.